Hello everyone, Assalamu alaikum. I hope everyone's fine and I hope you people are able to hear me. Can you hear me? Okay, great. So yesterday we did the basics of investment appraisal and we discussed how we calculate present values, the concept of net present value, and the concept of internal rate of return. Now, yesterday we discussed that once net cash flows for every year are given, how to calculate present values with the help of those net cash flows given. Now, today we have to learn how to calculate those net cash flows for which we were calculating present values. So, our today's session will be focusing on calculating net cash flows for the project for a project, and we will be doing it now on exactly the platform that you will be having on your exam day. So we'll be solving those questions on the spreadsheet platform. So let's start on your screens. Let us first go through the question information and then we'll see how we can solve this question using the spreadsheet. ABC company is evaluating the purchase of a new machine to produce product P, which has a short product life cycle due to rapidly changing technology. The machine is expected to cost $1 million, and production and sales of product P are forecast to be as follows. So for every year from 1 to year 4, production and sales figures have been given: 25,000, 35,000, 50,000, and 60,000. The selling price of product P will be $25 per unit, while the variable cost of product P will be $11 per unit. The purchase of machine will increase the company's fixed cost by $25,000 per annum. Producing and selling product P will call for increased investment in working capital. The investment will ask for an additional investment in working capital of $100,000, which will remain constant at this level throughout. The ABC company pays tax of 30% per year in the year in which taxable profits occur. The new machine is expected to have scrap value of $50,000 at the end of the 4-year period. ABC company uses after-tax cost of capital of 12% for investment appraisal purposes. Calculate the net present value of the proposed investment in product P. Now let's see how we can calculate the net present value in case we don't know what the net cash flows will be for every year. So on your screens you have the spreadsheet, and it is exactly in the form you will be witnessing on your exam day. And remember, the screen is adjustable as per your convenience. So let's start first. Well, I always have a practice of selecting the whole spreadsheet first, going into this formatting tool, clicking on it, and selecting the format that I would prefer. I always prefer this particular format. Sorry, it's hanging up. don't know what's wrong with this. Just give me a minute. Let me fix it. I'm sorry. I was just fixing the problem. There's some problem with the technical problem with the browser. So let's start again, and I hope it does not get hanged this time. So first of all, I always select all the cells by using this tab, and I go to the format, and I select this format, and not again. And no. Just excuse me for this mess. I don't know what's wrong. Select. So, well, now, first of all, since we know that the project has a life of 4 years, so we'll have to start from 0, 1, 2, 3, and then 4. So we'll start here. Just to present it in the correct way, we have to centrally align all those figures. We'll start from the sales. Remember, it's a very usual assumption in financial management paper that all the operating cash flows will arise at the end of the year. So point zero is always the start of the first year. So we'll never ever write sales figures or any other operating cash flow in this column. We'll always start from year one, which means at the end of year one. So at the end of the year one, we have 25,000 units sales with a price of $25. So 25,000 units into, that is Tariq, into 25. So the sales for the first year will be 6,25,000. Shoaib, what do you want me to repeat? So the sales figure or any other operating cash flows will always start from year one. So 625,000 for year one. And I will just copy this figure by using Control C to copy it and then Control V to paste. Now, we've got the same figures for every year, but definitely we have to change the sales volume for every year. So we'll just double click the cell and I'll just go to the cell and I will just change the sales volume figure, and from 25,000 I'll make it 35,000. Then I will go to the second cell. Again, I will double click on the cell and I'll make it 50,000 for year 3 as per question. Since the price for every year is same, so I don't need to change the price figure. I'll just change the sales volume figure for every year. So 60,000 for year 2. We can take it net of text directly as well, right? Net of text, no, the text should be shown after the operating cash flows. Once we have calculated the pre-tax cash flows, then we'll show it, then we'll just include our tax liability. It's a better way to present the question. Then from this figure, we need to deduct our operating cash flows, and the first operating cash flow figure will be for the variable cost. So I'll just put down the 25,000 sales volume for the first year, and I will multiply it with the variable cost for each year, and we'll do the same what I did in case of the sales volume. And I'll just change the production and sales volume figure for every year, make it 35,000, 50,000, and 60,000. So, but as you all know that sales figures are cash inflows, so we'll write it as positive values. But since variable costs are all negative cash flows, the cash outflows, so we must write it as negative figure. And how we can do it is just place the minus sign before the figure. So before every figure, we'll just place the minus sign to show it as a negative figure. Okay, now let's place the other operating cash flows, and let's put fixed cost. Since fixed costs will be constant uh, for every year, so we just need to place it in one cell and then copy the cell and paste, select all other three cells and Control V, and here we go, we've got fixed cost for every year. So remember, when we will be preparing this pro forma for calculating net present value, we have to write all the operating cash flows and all the expenses, cash expenses, which will be allowable for tax purposes. So we have to place all those figures before before we actually calculate the tax liability. So we have to search for any other operating cash flow which we have to write before the tax. So is there any other expense that we should be writing before tax? I think we don't have any other. So before we calculate the tax liability, we should sum all the cash flows from C2 to C4. So we have to sum. So when we'll apply the formula of sum on these three cells, it will automatically deduct whatever is negative. So we can call it pre-tax cash flows. So we can just copy this formula by pressing Control C and select these three cells and press Control V to paste this formula, and it will just give us the net figure of all these three cash flows in every column. After that, we'll just deduct the tax, which will be 30% as per the question. And it's very important to understand this line regarding the tax liability. It says ABC company pays tax of 30% per year in the year in which taxable profit occurs. Now you'll see two variations in this line. Sometimes it will say the tax is paid in the same year, like in this case, and sometimes it may say the tax is paid in arrears. So in that case, the tax liability will be calculated. Let's say the tax liability will be calculated for the first year pre-tax cash flow, but it will be shown in the second year because of the arrears, because of the tax being paid in arrears. But the rate of the tax will be applied to these tax cash flows, and it will be shown in the next column. But in this case, it says that the tax will be paid in the same year. So we don't have to go to the next column. We'll be showing the tax liability in the same column, but with a minus sign because it will be a negative cash flow. So minus 30% into, link the cell with the above value. So we'll just take 30% with the minus sign of the above value, and when we'll enter, we'll get 30% of the 325,000 as our tax liability. Now, all we have to do is we just need to copy this and select all these three cells and press Control V, and we'll be getting tax liabilities for every year. You can see, Asghar, we don't have any option. You don't have any option of doing this. So the best way, if you want to insert a row, the best way will be to, if you want, let's say for example, you want to insert a row between 5 and 6 because you've missed something. So you can't insert the row, but what you can do is you just select all this, press Control X, and then go to the next row and press Control V, and the whole figure will be shifted to the next row, and you will get another row here. So this is the way you can add a row. It's not actually adding a row, but you can do the same thing as adding the row. So I'll go back to the other. So these are the text figures. Now, after the text figure, there is also tax benefit on capital allowances, which I will discuss later on. At the moment, I'm just ignoring any tax depreciation impact on the net present value. So we're just ignoring that for the time being, because it is not even mentioned in the question as well that there will be any tax benefits on capital allowances. So I'm just ignoring it for the time being. After that, we will be incorporating any other cash flow which does not have any tax impact, and it will be the working capital. So according to the question, uh, if you want to invest in this project, you will also need to invest $100,000 for working capital requirements. That is, to run your day-to-day activities, you need to invest a further $100,000 besides investing in the machinery. So working capital will also be shown as cash outflow, but more importantly, it should be shown in the zero column, because for the first year operations, we need to inject this amount at the start of the first year, and the start of the first year is actually the zero column. So we have to write it here. Yep, $100,000. And since I think we have to change the format again, and the format, this was the format. So $100,000. Now, will working capital always be in year zero? Yes, since when you'll be starting a business, you have to invest the capital at the start of the year so that you can carry out your day-to-day tasks throughout the year. So you have to inject the very first working capital requirement at point zero. Now, for the rest of the years, we have to look at whether the working capital requirement is changing from one year to another, or it is staying constant. As per question, it says that the working capital requirement will remain constant at this level throughout, which means we do not need to inject any further capital for the rest of the project's life, as we have already injected $100,000 as capital, and it will stay in the business till the end. So we don't need to invest anything further for the rest of the years. But at the end of the project, once the project will be over, we will have to eject these $100,000 back from the project. So it will be shown as a positive figure at the end of the fourth year, and this will always be the case for every project that will end after a certain period of time in the future. So in the last year of any business, we have to eject the amount invested for the working capital. So it will be shown as a negative figure at point zero, and it will be inflow at the last year, in the last year of the project. Mariam, this isn't a past exam question, but it has been picked from the past exam question, but I've made some modifications to the question. But it's typically the same as you will see in the exams. So I hope everybody has understood the treatment of working capital. So it should always be shown as negative at point zero, and we have to show it as a positive figure at the end of the project. So if the question states that the working capital will be injected 2 or 3rd year, then we write in the second. Oh, well, so far I haven't seen any question which will say that you have to invest for working capital in year 2 or 3. Usually the question will give you the working capital requirement for every year, uh, and usually it will always be the point 0 where we'll have to show the first cash outflow regarding working capital. So for working capital requirement should always be injected at point 0, that is immediately for the first year. And then we'll see in the question whether this requirement is changing from one year to another. If it stays constant, if the question is clear about that, about the working capital, that it will remain constant throughout the year, throughout the life of the project, then we do not need to inject any further cash outflow during the life of the project. And in the last year, we have to eject this cash back, so it will be shown as positive cash flow. So after working capital, we'll have to look out for any other cash flow that we will be requiring for this project. Now it's the turn to write the initial investment, which is 1 million. So initial investment, again, investment, it's an investment, and it should be shown as a negative cash flow because we'll be purchasing the technology, and it is going to cost us 1 million. So I've written it as 1 million. Let me change the format because this isn't matching. So 1 million will be shown as negative as it's a cash outflow. And since we have invested, we will be investing 1 million at point 0. So there will be no cash outflows regarding this investment in the later years. Now, the last thing that we need to include will be the scrap value. That is the amount that we will be getting after the end of the project by selling the technology or the machine, whatever we have invested in. And since the scrap value will be cash inflow, therefore it should be shown as a positive figure at the end of the project's life. And may I know what's the scrap value? Here it is. It's $50,000. So $50,000 will be shown in the last year of the project. So I'll just try to underline all those figures because this is the net of the above figures, so we have to underline it. And now it's time to net off all those cash flows because we don't have any more cash flows left. So we'll be just netting off those cash flows, and we'll call them net cash flows. So to calculate the next net cash flows, we will sum all the figures from these pre-tax cash flows till the last row. So, and then I'll just copy this value and paste it in the rest of the cells to find out the net cash flows for every year. Hamad will come back to that point. Let's keep things simple for the first time. And we will solve a question in which working capital requirement will be changing in every year. So we'll come back to that point later. So here we go. We've got the net cash flows for every year. Now, once we have got the net cash flows for every year, the next step will be to find out the present values of these cash flows. And you know, to calculate the present values, we need discount factors. And discount factors should be in accordance with the cost of capital given in the question, which is 12%. So I'll go back to the discount factor row. Remember, we have to pick discount factors for 12%. Now we have two ways of doing it. One way of doing it is to pick up from the present value table, and the other way is to use a formula approach to calculate the discount factors for every year. Now I would like everyone to listen very carefully, because we'll be calculating discount factor using a formula approach. So let's calculate the discount factors, and I hope everybody is with me. Just look at your screens. I'm calculating the formula. I'm calculating the discount factor using the formula approach. Is equal to bracket 1.12, as the discount rate is 12%. So we'll write it as 1 plus R, 1.12, or let me write it as 1 plus the discount rate, which is 12%, and I'll write it as 0.12. I'll close the bracket, and then I will just put the cap sign here. This is the cap sign. This is the cap sign. This represents the power. So for power, we have to put cap, and then the power, as you all know, for calculating discount factor, the power should be negative. It should be minus. So it should be minus. Now, since we are at 0.0, so in this column, the power will be 0. So instead of writing 0, I'll just refer to this column, because referring to this column will help me copy this formula in the rest of the cells. And what will happen is it will automatically change the references as I copy it in the next columns. So I'll just refer this cell and I'll just enter, and it has given me the discount factor for year 0. And you know, for year 0, the discount factor will always be equal to 1. Now I'll just copy this formula by pressing Ctrl C, and we'll paste in the rest of the columns, rest of the cells, and (1.12) raised to the power minus C1. It's I guess the format. I have to change the format. If I go to this, I have to go to the format which will show decimal places, and it's better to show at least 2 decimal places. Here we go. So here we go. So it's showing 2 decimal places, up to 2 decimal places, or we can pick from here as well. All of these have got 2 decimal places. So we've shown it as 2 decimal places. Now, all we have to do is to multiply the net cash flow with the discount factor. So here we go. We've got the first present value, and I'll just copy the formula from this cell and I'll paste in the next cells. Here we go. The format, again, we need to change the format. So here we go. So these are the present values. So I'll just write present values. So we've got present values for every year using the formula approach. I'll just try to underline these figures for the sake of presentation, or I may highlight. I may go to highlight this cell. So there's a bold figure. So we've got present values for every year. And now in order to calculate the net present value, what we need to do is we just need to sum all the values from this cell to this cell and change the format. So here is the net present value of this project. Will we be given the discount table, right? Yep, you will be given the discount table, but I don't think we need discount table. Once we have Excel, it's better to use formulas to calculate the discount factors, that it will give you more accurate answers than the discount factor or discount annuity factor tables. So now, any questions? Any questions? It's I'm sorry, I can't pronounce your name, uh, but this question isn't there on the slides. It's actually the Excel based question, uh, so you don't have this question. Okay, GS, thank you for making things easier for me. Well, Khalid, I will share, as you people all are there on the WhatsApp group, I will share um, the credentials for the online access of the questions of financial management on that WhatsApp group. So make sure that all of you are on that WhatsApp group, and I'll share how you people can solve these questions online. Sadek, the formats here are the two tools to change the format of the question as per your convenience. If, for example, if you click on the cell and you want to change the format, just go back to this tab, click on it, and you have got a list of formats, and you can choose any of the format that you like to have. So here are the formats on the screen. So choose any one that you would like to. So how can we access to Well, the WhatsApp group details will be shared with you in the same chat box in a while. So you can just copy that link and use that link to join the WhatsApp group. Okay, in case you're having problems uh, joining the WhatsApp group, I'm just writing my WhatsApp number. Just note it down. Text me on this number on WhatsApp. I'll just send you the link to join the WhatsApp group. So any questions regarding this solution, or should we move towards the next question? Okay, let's move towards the next question then. What if the values get differ when we use the present value table? Oh, it won't make that difference, Sandali. It is not going to make that much difference. If you want to use values from the present value table, you can go ahead with that. But I would recommend if a spreadsheet is given there, use it as much as you can to take benefit of it. Okay, Sakeen, I did send links to a few of the students who have texted me. Could you just send me that text again? Maybe I have missed it. Okay, let's move towards the next question. Okay, before we move towards the next question, let's first calculate the IRR, because the requirement says that we need to calculate IRR as well. So we have if you look at this question, we've already got NPV, which is positive at 12% per annum. It's 12%. It's positive at 12% per annum. So let's increase the discount rate and calculate the present values again. and let's find out a negative NPV at a different rate, and then we'll use those two NPVs to calculate the IRR as we did it in the last uh, session. So let's take another discount factors at a discount factors at higher rate. Let's take it at 20% and hope we get a negative NPV, because the NPV is too high, and I'm not sure whether we'll be getting a negative NPV at 20%. Let's try. So all I have to do is I will just pick, I'll just write the formula again for calculating discount factors. 1 plus 0.2 this time, as it's 20%, cap, minus sign, refer back to the years cell. Here we go. Just let me copy. So, and now let's change this format to decimal places. There we go. We've got a decimal place here. So we've got the discount factors again. Let's calculate present values again. The net cash flow, which is 1.1 million in the first year, multiplied with the discount factor. So, and let's change the format of this row. So we've got, now this NPV was at 12%. So let's mention it here. Now we will calculate another NPV at 20%. Apply the formula of sum to all these cash flows. So okay, we've got the negative NPV. So now we have got two net present values, one with 12% rate and the other with 20% rate. Now we've got two rates. So just quickly, if you people can calculate the IRR for me using your calculators. And then I will calculate the same using the spreadsheet. If you can just calculate the IRR using the formula that we discussed in the last session. And I want everybody to calculate this IRR for me. Great. I want others to calculate the IRR. We have to make sure that this is more interactive session. I don't want anybody to sleep. Let's have it an interactive one. Come on, I'm waiting for your answers. 1, 2, 3, 4, 5, 6. We've just got 6 answers. I don't want to be the 7th one. I want to be the last one to calculate the IRR. Just come up with the answers. Great, Kumesh. Next one, come on. 25%. Are you sure? We've already got a negative NPV at 20%. So how can we have a zero NPV at 25%? Remember, your IRR will be in between the 12 and 20%. It can't be more than 20%, because at more than 20% rate, the NPV will be further negative. It can't be zero, and it should be in between 12 to 20%. Okay, so we've got enough answers. Let's solve it using this spreadsheet. So is equal to, first of all, we need the lower rate, and of the two rates, 12%, 20%, the lower rate is 12. So we should write 12 plus, we need a positive NPV, which is 156, as I'll just refer to the cell, divided by, and then bracket open, the positive NPV minus the negative NPV. And I'll close the bracket, close the other bracket as well. And then it should be multiplied with the difference between the two rates, which is 20 minus 12. So I'll just enter it. I'll just go to the format, and I'll just go to the format which gives us up to two decimal places. And here it is. It's 17.69%. So it's 17.69%. So majority of the answers are correct, and it's a good sign. So if you want me to show you the formula that I just applied, you can see it as the lower rate, 12, the positive NPV, B16, divided by B16 minus B17. Eventually, these two values will be added together. And then we have to close the brackets and then multiply the answer of the equation in the bracket multiplied with the difference of the rates. So this is IRR 17.69%. So let's move towards the next question. Okay, if you people can just quickly take the screenshots of the question. If you can just take screenshots of the question. Should I drag it down? Okay, here we go. Okay. So if you people are done with the screenshots, okay, I'm giving you 10 minutes, and within those 10 minutes, you people have to solve the same question. Now it's up to you whether you use Excel on your computers, or if you want to go to the ACCA's website. I'll just show you how you can go to ACCA's website, ACCA. PM specimen, that's right, FM specimen exam ACCA. Just go to the Students tab, click on Exam Support Resources. Click on Exam Support Resources, click on ACCA Qualification, Paper Financial Management. Here we go, Financial Management. Go down. Go to CB Specimens. And click on Constructed Response Workspace. You can directly search on the Google, the Constructed Response space on ACCA page. You have to scroll it down before you can move to the next. Okay. Next. Yeah, I want to start. Okay, here we go. So here is the workspace, but it is for word processing. So just go to Navigator, click on the Navigator, and drag it down. And once you see the spreadsheet here, click on anyone. Here we go. So here you have the same workspace that's here. So use this workspace or use your Excel spreadsheet, but I would recommend you to use this one and solve the question. Abdullah, do you want me to drag down? Okay. Do you want me to go down further? Is it okay, Mariam? Okay, go ahead and solve the question. Meanwhile, I have to offer my prayers, so just give me 5 minutes. I'll be back in 5 minutes. Well, I'm back, and let's solve the question. A name company, a software company, has developed a new game, Tango, which it plans to launch in the near future. Sales of the new game are expected to be very strong following a favorable review by a popular magazine, etc., etc. It's actually a past exam question which has been slightly modified to make it more simple. Uh, Sales for every year have been given, and it seems like it's a 4-year life product. So let's start. First of all, let's change the format, and this format is going to work for us. So it will start from 0, 1, 2, 3, and then 4. Let's centrally align these values, and let's start from sales. It will always start from year 1. So we have 120,000 in year 1. And we can also write these figures in thousands. So let's write in thousands. So 120 instead of 1,20,000 into 26, the price per game. So 3120. Then it's 130 into 25, 90 into 23, and we have 50 into 22 for the last year. Then we should deduct the variable cost, and variable costs 5, 7, 12. So the total variable cost per unit will be 12. 120 the sales volume in the first year multiplied with 12 variable cost. This is for the first year. And do we have any change in the variable cost per unit in the subsequent year? Okay, no. So it will stay the same. That is 12. But the sales volume will be different for every year. So 130 in the second year multiplied with the 12, then 90 multiplied by 12, then 50 multiplied by 12. And since it's a negative, it should be negative. I always forget to place the negative minus sign. So okay, then we have fixed costs. Fixed costs. The fixed production cost is $5 per game for the first year, but we have to write the total fixed cost rather than the per unit fixed cost. And remember, this fixed cost per unit has been calculated using the first year activity level. And as you know, that fixed cost usually does not change with the change in activity level. So we just need to multiply it back with the sales volume for the first year to get the fixed cost for the first year. And in the absence of any other information, we will assume that the fixed cost will remain constant at this level throughout the life of the project. It will only increase if the question mentions that there is inflation in the fixed cost, or there is any step up fixed cost, which the question will have to mention. Otherwise, in normal case, we will always assume that the fixed cost will remain constant throughout the life of the project. So it's 5 in the first year, fixed production cost, FPC in short, fixed production cost. It's $5 for the first year, and the sales volume for the first year is 120. It's 600, and we'll have to keep it at the same level. But before we move forward, let's first make sure that there is no change in the fixed production cost. Advertising cost to stimulate demand are expected to be $600,000 in the first year of production and will be reduced to $200,000 in the next year of production. No advertisement costs expected thereafter. Fixed costs represent incremental fixed production overheads, and Tango will be produced on a new production machine costing $900,000. So nothing is mentioned, and we have been asked to ignore inflation. So it means the fixed cost will remain constant at this level throughout the life of the project. So it will be 600 throughout. I hope it's clear. So we have advertisement costs, and according to the question, the advertisement costs will be 600,000 for the first year, means minus 600. And then it will be reduced to 200 in the second year, and no advertisement costs are expected in the next 2 years. And do we have any other operating cash flow which we should be incorporating before the tax? No, we don't have any other tax allowable expenditures, so we'll just calculate the pre-tax cash flows. Sum from top to bottom, 480, and we'll copy paste all these values. So we're done with the pre-tax cash flows. Now it's time to incorporate tax, which is at 30%, and make sure that it is paid in the same year or in arrears, 30% per year, and the tax liabilities are settled in the year in which they arise. So again, it will be in the same year. It will be 30% of the pre-tax cash flows. So 144, and let's copy and paste it in the rest of this. Now you can see it's a positive value because you have a negative cash flow at the end of year 4, which will help you save the tax liability. So you'll get $30 saving in your tax liability. Therefore, it's shown as positive in the last year because the losses are usually allowable for tax purpose. And whenever you show a loss from one venture into your total profit, it helps you reduce your tax liability. So it's shown as a benefit. So then we should incorporate initial investment, which is 900 as per question. And do we have any scrap value in the question? Tango will be produced. Nothing is mentioned regarding the scrap value, so we will assume that there will be no scrap value at the end of the life. And what's the working capital requirement? Here we go. Here we have working capital requirements. So I have a confusion in fixed costs. Yeah, Zuhaib, what confusion? What type of confusion do you have? Yeah, it's per unit, and you know fixed cost is never spent on a per unit basis. So this per unit has been calculated using the first year's activity level. So to get back to the total fixed cost, we have to multiply this per game or per unit cost with the activity level of the first year. So if you multiply it with 120,000, we get 600,000. Okay, so we're done with the investment part. Now let's look at the working capital. Now I want everybody to be listening very carefully. In year 1, the company needs a working capital equal to $50,000. Now, what it needs during the year 1, it has to inject at the start of year 1, which is 0.0. So at 0.0, it needs to invest $50,000. Since the figures are all in thousands, so we'll just write 50. Now, in the next year, the requirement is increasing by $10,000. So a total of $60,000 will be required for the second year's operation, and it will be injected at the end of year 1. so that we can carry out our day-to-day task in year 2. The total required investment will be $60,000, of which $50,000 have already been invested at point zero. So we'll just have to invest a further $10,000 because we have already invested $50,000. So we'll just have to adjust up to $60,000 by investing a further $10,000. So in the next year, the requirement is increasing to $75,000. So my question to all of you is, what amount should I show in the second year regarding working capital? Excellent. Yep, it's 15. A further 15 should be invested at the end of year 2. Yep. So for year 4, it says that the working capital requirement will be just 45,000. And remember, at the end of year 2, we have invested up to 75,000. But for the next year, we only need $45,000. So what do you think? What should I write here? Yeah, we have to withdraw 30,000, so it will be shown as positive value. So if we show it as positive, the working capital investment will be reduced to $45,000. And then it's the end of the project, the last year. And in the last year, we'll show a positive 45. And remember, usually the sum of all these should be 0. So to make sure it's 0, I just summed all these values, so it's 0, because we have to eject all the working capital by the end of the project. Is it clear? Okay, so we don't have any scrap value, we don't have any other cash flows left, so let's net all the cash flows, net off all the cash flows, sum, and here we go, here we pre-tax cash flows. So these are the net cash flows. Let's take discount factor, and the discount factor should be at 10%. Let's go back to the formula. 1 plus 0.1, that is the discount rate is 10%. Cap minus, referred back to the cells containing the years. So let's copy and paste these figures here. And now just change the format to decimal places, to 2 decimal places at least. Here are the 2 decimal places. There we go. And now we need to multiply the net cash flow with the discount factor to get the present values. And let's copy this figure and paste it here. Here we go. We've got present values. So let's calculate the net present value. Sum of all these. And let's change the format to so it's 59.42, and you know that these were in thousands, so let's multiply it with 1000 to get back the answer. So this is the NPV. Go back to the formula. GS, which formula are you talking about? Discount factor, okay. Here is it. So it will be okay to do operating cash flows working inside aside from our NPV. So it will be okay to do operating cash flows working. Uh, well, it's better to show uh, all the workings within the cell so that the examiner will be checking your solution, he does not need to go here and there. So it will be very presentable if you just look at from the examiner's point of view. This is the net present value. You'll just go to the net present value, double click it. You'll see that how this NPV has been calculated. You'll see the formula. It's the sum of all these figures. So you'll go back to those figures and you just click on this to see how this figure has been calculated. So you'll get the reference of the cells. So you'll go back and see how those values have been calculated. So it will be very convenient for the examiner to check. So in all these type of questions in which fixed cost is given per unit, we will use the first year basis. Mohammed Zul, we have to make sure that which activity level has been used to calculate the per unit. We have to multiply this per unit back with the same activity level to get back to the same fixed cost. So this is something that we have to look at into the question. And the question will usually make it very clear that how this per unit has been calculated. So as was the case in this question, it clearly mentioned that the fixed cost per unit is calculated on the basis of the first year operations. So that's why we multiplied it back with the first year's activity level. So if we have been given fixed cost per unit for every year separately, then we have to multiply this fixed cost per unit usually with the same year's activity level. Okay, so I hope you people will be able to calculate the IRR of the same question. So I'm moving forward to the next question. So we've got another question here, and we are again supposed to calculate the net present value. Let's go to the question. Tech company needs to increase production capacity to meet increasing demand for an existing product Neo, which is used in food processing. A new machine with a useful life of 4 years and a maximum output of 700,000 kilograms of Neo per year could be bought for $1 million payable immediately. The scrap value of the machine after 4 years would be $50,000. Forecast demand and production of Neo over the next 4 years is as follows. Uh, this is the total demand of this product, 1.5 million. And remember, uh, this tech company is trying to increase its production capacity. So it's not something new that it is going to produce. It is an existing product that it will be producing, but with an increased capacity. Now, the existing production capacity for Neo is limited to 1 million kilograms per year. Remember, at the moment, the company can only produce 1 million kilograms per year. And with the help of this new technology, it can increase its capacity up to 1.7 million. That is the additional 700,000. So the total capacity of after this investment will be 1.7 million. So if you look at the demand in year one, it's 1.5 million. So definitely there is no point of producing above this limit because the company won't be able to sell it. Even if it has the capacity, it won't produce above this level. So the maximum that will be produced in year one will be 1.5 million. But the whole 1.5 million is not relevant for this particular question because 1 million is what what the company is already producing. So remember the concept of incremental revenues and incremental costs. We'll only take the incremental portion of the revenues and the relevant incremental portion of the costs. So 1 million is the existing capacity of the company. So 1 million will be irrelevant. Whatever we'll be producing above 1 million will be relevant for us. So if for the first year, since the demand, the total demand is 1.5 million and 1 million is the existing demand, so the additional demand that we will be taking into consideration will be only 0.5 million, or we can say 500,000. Is that clear? Okay, great. So in the second year, what will be the relevant demand for the second year? And for the third year? So this is the trick. In the question, the total demand given is 1.8 million, but you know that the maximum capacity is just 1.7 million. So that additional 0.1 million demand will be wasted. So we can't capitalize that demand. So the maximum that the company can produce will be 1.7 million for year 3, of which 1 million is the existing capacity. So it should only be 0.7 million or 700,000. And in the fourth year, again, it will be 700,000. Though the demand is 2 million, but since it's more than the capacity of the company, therefore it can't go and produce all. So let's start now. Again, it's a 4 years project. So, and figures are again in hundreds and thousands. So let's write these figures in thousands. 0, 1, 2, 3, and 4. Let's write the sales. The sales, the incremental sales will be 500, as we have already discussed. 500 into price per unit. The selling price of Neo is 9 per kilogram. And is it expected to increase in the later years? Other variable cost of production are 3 per kg. Fixed cost production with the new machine would be 250,000 the first year production, increasing by 25,000. So there is no increase in the variable cost per unit. So in the price per unit. So I will write 500 into 9. So 4,500. And let's change the format. $500. Then for the second year, it is 600 into 9. Then it's 700 into 9 for both next 2 years. So just copy paste. Okay, I think I've done a mistake, so I'll just cut it and write it here. Why 1.7 million? Sakeen, for the third, are you talking about the third year? If you look at this additional machine has a capacity of 700,000 kilograms and the existing capacity is 1 million. So if the company invests in this new technology, it can increase its capacity by 700,000, which will make it 1.7 million. Is it clear? Okay, let's deduct the variable cost. The sales volume for the first year, 500. The variable cost is 5 for material and 3 for other production variable production cost. So it will be 8 in total. So 4,000. Then we have 600 demand into 8. 700 into 8. And we have 700 into 8. So then we have fixed costs, which according to the question, fixed cost is $250,000 in the first year. So minus 250. 3-year sales. Well, the third year sales total demand is 1.8 million, but the capacity of the company is limited to 1.7 million if it goes for this project. So it's 1.7, so it cannot produce 1.8 million. So the total that it can produce will be 1.7 million, of which 1 million is the existing capacity. So even if it does not invest in this project, it is still able to produce 1 million. So 1 million will be something out of question. So the additional capacity that it will be able to utilize because of this technology will be these additional kilograms that it can produce with the help of this new technology. So that's why for the third year and the fourth year, the additional sales will be 700,000. Clear? So 250,000, and according to the question, it will be increasing by 25,000 every year. So 275 for the next year, 300 for the year 3, and 325 for year 4. So every year the fixed cost will be increasing by 25,000. How are we judging that? We need to take, it's always the case, Iram, because we are taking the decision about investing in the machine or in the new technology. So we will always consider the impact of the new investment in our sales and our costs. So we'll just be taking the additional revenues and additional costs into account that we will be generating because of the introduction of the technology for which we are deciding. So it should always be the additional amounts. So fixed cost, okay. Do we have any other expense that we need to write before we can actually charge tax? Tech company pays 1 year tax 30% and can claim allowances. No, we don't have anything. So let's sum these figures. And these are the before tax figures. Now we'll apply tax, which is 30%. And if you look at this line, it says tech company pays tax 1 year in areas. So remember, we will apply the tax percentage to this figure, but we'll show it in the next column because of areas. So 30% of 250,000 will be shown in the next column because of areas. So then we'll be taking 30% of 325, but we'll be showing it in the next column. Then we'll be taking 30% of 400, should be a negative figure, and then 30% of 375. $2.5. Is it clear? Okay, now let's read this paragraph again. Tech company pays tax 1 year in arrears at an annual rate of 30% and can claim capital allowances, that is tax allowable depreciation, on a 25% reducing balance basis. What does this mean? It means that every year the tax authorities will allow this company to claim additional expense in the name of tax allowable depreciation. That means it can calculate tax depreciation at the rate of 25% and can claim it as expense. And what will this do to the company is that it will reduce the tax liability or the tax outflow of the company. Since this reduction in the tax liability is a benefit to the company, and this benefit is because of the purchase of this machinery, therefore this benefit should be shown as a cash inflow for the company, because this benefit can only be obtained if the company decides to invest in this technology. So we have to show this benefit as cash inflow, and we call it as tax benefit on capital allowance or balancing allowance. I'll just discuss in a while what balancing allowance is. So let's see how we calculate this tax benefit. Just try to create a section for working. Oh, that's time up. Why is it should not have happened. I want to restart again. Okay, so I don't want to restart again. So we'll just continue from where we left, and that was for capital allowance. Now, remember uh, how we calculate the capital allowance for every year. It's simply the reducing balance depreciation that you people may have learned in your earlier studies. So we'll see just how we can calculate. So we'll just place a heading for the working tax benefit on capital allowance slash balancing allowance. Okay, let's place a dollar sign here. We'll start with the cost of the asset. So the cost of the asset is how much was required to be invested. Where is the investment? $1 million. Here it is. So we were supposed to invest $1 million, which is 1,000 if we write the figures in thousands. Okay, so $1,000 is the cost of the asset, and in the first year, the tax authorities will allow us to claim a capital allowance equal to 25% of the cost of the asset as depreciation, which will be 25% of the cost of the asset, which will be 250. So 250 will be the tax expense or depreciation for the first year. So what will this do is it will reduce our taxable profit by 250,000, which means that the company will have will not have to pay tax for these $250,000. So the tax rate is actually 30%. So 30% of 250,000 will be saved in tax payments in year one. This is called tax benefit uh, because of this capital loss being claimed. Is it clear? If not, I will explain it again before I can move forward. Is it clear? Okay, let me explain again. In the first year, this company will calculate its tax allowable depreciation, which is 25% of the cost, 1,000, 25% of 1,000, which is 250,000. This capital allowance will be claimed as a tax expense, and the taxable profit will be reduced by 250,000, which means that the company can save tax at the rate of 30% on this 250,000. If we take 30% of 250,000, it gives us 75,000, which means that the company will save $75,000 of tax payment because of claiming tax depreciation in the first year. So 75,000 is the reduction in the tax liability because of claiming this capital allowance, and this capital allowance will only be available if the company goes ahead with this technology. So this is the benefit that the company is going to receive from investment in this technology, 75,000. But because of the tax being paid in arrears, the year of payment will be year two. So we'll show this tax benefit in year two column because of arrears. Had it not been in arrears, we would have shown it in year one. Because of arrears, we have to show it in year two. For the next year, your WDV will be 750, and since the tax depreciation is available at reducing balance method, therefore every year the capital allowance will be calculated on the WDV rather than the cost of the asset. So for the next year, the capital allowance will be 25%, but this time the 25% will be applied to 750. The rate will be same 25%, but the base value will now be the WDV. So it's 188. Again, it will help the company save 30% of this value in its tax liabilities. It will save 30%. 188 into 30%, which is 56. And it will be available in year three because of arrears. Now the WDV for the next year, this was for the first year, this was for the second year. Now we are entering into the third year. Let's calculate the WDV. It's WDV. And for the third year, again, it will be able to claim capital allowance at the rate of 25%. 25% of 563. It's 141. And then we'll take 30% of this amount as our tax benefits, which will be approximately equal to 42 and will be shown in year four. Remember, this tax capital allowance is for year three, but because of area, it will be shown in year four. Now we are entering the last year of the business. So let's calculate the WDV for the last year. It's 422. Now, since we've entered into the last year of the project and we know that there will be no further years left to claim this tax benefit, to claim this tax benefit. So this is the last year in which we have to claim the rest of the cost of the asset. But according to the question, this asset will be sold for 50,000. It means that whatever we invested in this technology, we'll be able to recover 50,000 from it. So the tax authorities will never allow these $50,000 to be claimed as expense, because this is something that you will be receiving from your investment. So in the last year, we will just subtract this scrap value from the WDV, which is 50. And whatever is left will be claimed as tax depreciation. But since this tax depreciation is not calculated at 25% rate, so it is not normally called capital allowance, it is called balancing allowance, as it is a balancing figure. Out of 422, the company will be able to recover 50,000. So the rest of the amount will not be recovered by the company, and the tax authorities will allow it as the expense of the business in the last year. So this is called balancing allowance and not the capital allowance. In case we did not have any scrap value, then the whole of 422 would have been claimed as balancing allowance. Because of the scrap value, the balancing allowance will be reduced to $372. And now we'll take 30% of 372 as our tax benefit, and it will be claimed in the 5th year. So these are the tax benefits: 75, 56, 42, and 112 approximately. And it will be shown in year 2, 3, 4, and 5 as our cash inflows. Any questions? So how could we know any balance charge? It's very simple. In the last year, for the last year, you need to calculate the WDV. So if you have a WDV 422 in the last year, and if you don't have any scrap value, the whole of the WDV will be treated as balancing allowance, right? It will be a balancing allowance. But if we have a scrap value, and that scrap value is lower than the WDV, so we'll reduce the WDV by the scrap value figure, and this will be called as balancing allowance. But in case the WDV, that is the unclaimed cost of the asset, we haven't claimed $422 as our expense so far. So this is called the unclaimed cost of the asset. The WDV is $422. And in case the scrap value is more than the WDV, for example, in this case, if the scrap value was, like, let's say $500, the WDV is 422, and the scrap value is more than the WDV, in that case, there wouldn't have been any balancing allowance. In that case, there would have been a balancing charge. Let's say it's minus 450. The WDV is minus 450, minus 500. So in this case, instead of balancing allowance, it will be a balancing charge. That is, we will show it as our additional tax rather than tax benefit. So we'll show it as a negative figure, and it will be called as balancing charge rather than balancing allowance. Is it clear? Is it clear to everyone else? So remember, whenever the scrap value in the last year is less than the last year's WDV, there will be a balancing allowance. But in any case where scrap value is more than the WDV of the last year, then the difference will be called as balancing charge. And if we apply 30% to that balancing charge, it will give us a negative figure, and we'll show it as cash outflow rather than cash inflow. So do remember this. Okay, this is how we incorporate the impact of capital allowance in our NPV. So we'll show these figures as our cash inflows in their respective years. Since we had to resume the test again, so we don't have those previous figures that we have calculated, but you have to show these tax benefits in these columns. Once you've shown these cash flows, you will add it into the other cash flows calculated in every column, and then you will come up with net cash flows. Once we have calculated the net cash flows, then all we had to do was to find the net present values of those cash flows. So since we do not have those values again, I don't want to go back to that. So let's move towards our next question. Do you people have any questions? Okay, let's move towards the next question. And in this question now we have inflation as well. So we'll be dealing with inflation as well. Now, so far what we have done is we have discussed the impact of working capital, the constant working capital, and the changing working capital. Uh, and we have already discussed the impact of capital allowance on the tax benefits. We're done with that, and now we'll be incorporating the impact of inflation on our investment appraisal. So let's go through the question first. PV company is evaluating an investment proposal to manufacture product W33, which has performed well in test marketing trials conducted recently by the company's research and development division. The following information relating to this investment proposal has now been prepared. Initial investment is $2 million, selling price is $20, and current price terms. So whenever you see inflation in the question, you will usually see this term mentioned, current price terms. It means that the price of the product is quoted as of now. That is how much it will cost us, or for how much we will be able to sell it today. That's called current price terms. And remember, all the operating cash flows are always assumed to have been occurring at the end of the year. So inflation is something that needs to be adjusted right from the very first year, because the prices mentioned here are for point zero, whereas the first sales figure that we'll be showing will be at the end of year one. So there'll be 1 year gap between the two. So we'll have to adjust the inflation right from the very first year. So the price is expected to be 20 if the product is to be sold today, but it is expected to inflate at the rate of 3% per year. Same goes for the variable cost, as it will also be inflated at the rate of 4%, and the variable cost per unit is $8, with the fixed cost $170,000 per year. The sales volume for each year has been given as follows. It is expected that all units of W33 will be sold in line with the company's policy of keeping no inventory of finished goods, no terminal value, that is no scrap value. When production of W33 planned for investment purpose, the company uses a nominal discount rate of 10%, and the target return on capital applied is 30%. Ignore taxation, calculate the net present value. So let's see how we incorporate inflation into our investment appraisal. So let's write the figures in thousands. Let's change the format. So we'll start from year zero as usual, 1, 2, 3, and then 4. It's a 4 years project. We'll start with sales first, and sales should always start from year one. The sales volume for year one, it's 60,000. So we'll write it just 60 into the price 20. Now, if I let it as it is, it means I haven't incorporated inflation, which I'm supposed to incorporate. So 60 into 20 is what it will make us earn at point zero, whereas we are standing at point one, that is the end of the first year. So we must incorporate 1 year inflation impact into this figure. So how we can do it is just take the Is everybody facing the same problem, video problem? Okay, so 60 into 20, and then we have to inflate it by the percentage of inflation of selling price, which is 3%. So we'll just write 1.03. 1.03. Now, if I just take the power 1 for year 1 and I refer it to the cell, so that when I copy and paste the formula in the subsequent cells, it also changes the power sign from 1 to 2 and then 2 to 3 and then 4. Or we can just let it be 1.03 and it's 1236, and let's copy paste here. So it's showing 1236 for every year, but we have to change it because we have to change the sales volume. The sales volume should be 70, price should be 20, but 1.03 is just a 1 year's inflation, whereas now we are 2 years away from 0.0. So the price of 20 is at 0.0 and we are 2 years away from this point, so we have to inflate it with a power 2. So 1485. Then the sales volume for year 3 is 120 into 20 into 1.03, but this time the power should be 3 to inflate this price for 3 years. And then the last year, the sales volume should be 45,000 into 20 into 1.03 raised to the power 4. So these are the inflated cash flows for every year, and we can call these cash flows as our nominal cash flows. So nominal cash flows, remember, are those cash flows which are inflated. So the inflated cash flows can also be called as nominal cash flows. So we are just 25 minutes away from the end of the session, and I just need to complete this question. So can we take this prayer? Can you offer the prayers after 20 minutes? So now let's look at the variable cost. The variable cost will be for the same level of units, so that is 60,000, 60. But the variable cost per unit is $8, 8. And the inflation rate is 4% in case of operating costs. So variable cost is part of the operating cost, so it will be 4%, so 1.04. So for the first year, it will be 1.04. So let's copy the formula, and 60 will be replaced by the sales volume for the second year into 8 into 1.04 raised to the power 2. I just forget. It should be shown as negative figures. So we'll just need to place the minus. Okay, for the third year, the sales volume will be 120,000, and the power of inflation should be 3. And for the fourth year, the sales volume will be 45,000, and the power of inflation will be 4. So these are the variable cost figures, and then we'll have fixed cost figures. Fixed costs 170,000 per year, and again it's in current price terms, which means we have to inflate it right from the very first year. So minus 170 into, since it's on its operating cost, so it will inflate at 4% per annum, so it into 1.04. So haven't placed the is equal to sign. Okay. So for the next year, the power, okay, will be 2. Third year, the power will be 3. And for fourth year, the power will be 4. So here we go. We've got the fixed costs as well. So let's see if we have any other costs that should be shown before tax. Since we were supposed to ignore the tax, so we're no tax, then there will be no tax benefits on capital allowance. Once the tax has been ignored, then anything related to tax should not be incorporated in PV. And capital allowance, the tax benefit on capital allowance uh, is something to do with the tax. So if we have ignored the tax, it means there will be no tax benefit on capital allowance as well. So any other expense that we need to incorporate? Okay, I don't, no, we don't have any other expenses. So we are done with all the operating cash flows. So let's net off all those cash flows. So 560 and copy paste. These are the net cash flows. So after that, we need to calculate discount factors and discount factors. Now, since we have inflated all the cash flows, it means we have converted all the cash flows into nominal cash flows. So once we have inflated all the cash flows, remember, always using the nominal discount rate rather than the real discount rate. Inflated cash flows, that is nominal cash flows, will always be followed with the nominal discount rate. So since in this question we've already been given with the nominal discount rate, so we do not need to bother a lot, we just need to incorporate it. So the discount factor is 10%, which is nominal, luckily. So let's calculate the discount factor using the 10% rate, power minus 1. And let's change the format to 2 decimal places. And let's calculate the present value by multiplying the net cash flows with the discount factor. Okay, have you missed something here? We've missed the initial investment here. We have missed the initial investment. So let's cut the whole 2 lines, paste it down. So let's write initial investment, which is minus 2 million, that is 2000. So the net cash flows will be sum of all these 2000. So (1.1 raised to the power minus 0). Well, I will just share the details on the WhatsApp group, Abdullah. So present values, here we go. These are the present values. And if we want to calculate net present value, we just need to sum all these. So the NPV, and since the NPV, all the figures above were in thousands, so we just need to multiply by 1000 at the end to get the full figure. So it's 367,785 net present value. Is it clear? So any questions? So we are done with today's tasks, and we still have time left. So if you people have any questions, uh, you may ask me. So we can spare some time for your questions. Well, the return on capital employed at the moment had nothing to do with us. If we have to calculate the NPV, or we have to calculate IRR, or we have to calculate discounted payback period, in all these three things, we had nothing to do with the return on capital employed. Yeah, these lectures will be available on Vimeo platform, and you can always access them. Yeah, I said that I will give the details on the WhatsApp group, that how you people can access to those questions. Juanita Fernando, I hope you have joined the WhatsApp group. Uh, on the WhatsApp group, I will share the details where you people can find these questions. I can also share these questions on the WhatsApp as well. Okay, I hope everybody here has my WhatsApp number. So in case you people are having any sort of difficulty joining the WhatsApp group, just text me on the WhatsApp, and I'll share with you the link of WhatsApp. So how helpful was today's session, especially solving on the spreadsheet? My WhatsApp number is right there on your screens. I've just written my WhatsApp number, 00923212604033. Yes, Nadine, we will be discussing theory as well. You'll be most welcome. Surely, Sakeen, I will add you. I'm really glad to know all this, and I hope these sessions will benefit you people to pass your exams. Okay, it's that's all for today. Yeah, Sneden, I will share theory notes on the WhatsApp group, uh, and any other study material that will be helpful for you. I'll be sharing on that WhatsApp group as well. Thank you very much. Have a good day. Bye bye. Thank you so much for the compliments, everyone. Thank you so much for the compliments, and you're most welcome.